Okay, Assalamualaikum warahmatullahi wabarakatuh. Okay, I'm Puan Nur Anisa. Today we are going to look into the last part of the statement of cash flow, that is on the indirect method. Okay, so what is actually the indirect method? I have already explained it in the previous PowerPoint. So today we're going to look into how to report and prepare the operating activities using the indirect method. Okay, so what is the objective or the learning outcome that is expected for this chapter? Okay, so it is the last outcome, that is to contrast and between the direct and indirect methods of calculating net cash flow, okay, from the operating activities, and preparing the statement of cash flows. So the indirect and direct methods will actually produce the same results in terms of the changes in net cash for the operating activities. So whichever method that are used in reporting, it will actually convey the same results. Okay, both methods are actually under GAAP. Okay, so an organization can choose whichever method that they deem is suitable for their business organization in reporting the cash flow statement. So when we look into the indirect method, usually the format is done to show adjustment or reconciliation of items in the income statement and also items in the comparative balance sheets with the net income to arrive to the net cash changes for the operating activities. Okay, so usually it begins with the net income. Okay, so a net loss. Okay, so this is from the accrual based accounting perspective. Okay, and then we are going to make adjustment. Okay, so to convert, okay, all the items that are in accrual basis accounting to cash accounting. So when you do the adjustment, you will actually add or deduct, okay, the certain items, okay, that are listed as non-cash activities, and also you will look into the changes between accounts in the balance sheet. Okay, so this is done by comparing the comparative balance sheets. Okay, the balance sheets of the period prior and the current period. Okay, so from the accrual basis accounting, we're now going to change it into the cash basis of accounting. So we'll start with information from the net income. Okay, so that will be the information, the basics of information that we'll use. We'll take the net income, and then we will adjust, okay, the net income to the net cash flow from the operating activities. So we will take some items under income statement, and also uh, the the differences, okay, between between a few accounts under the balance sheet. Okay, so that at last we will get the net cash flow from operating activities. So this is the list of items that needs to be adjusted, okay, when you do the indirect method approach. Okay, basically what you can do is to memorize uh, whether it should be added or it should be deducted. Okay, so we'll start with the net income or the net loss. So depending on what you stated in the income statement of the organization, whether it's a net loss or it's a net income. Okay, so if it's a net income, then it's positive number, but if it is a net loss, it will be a negative number, okay, that you show in a bracket. Okay, so that shows that it's negative number. Okay, so the sign is minus. Okay, then you will have to write down, Okay, this wording. Okay, so start with net income and then write down this wording. Adjustment to reconcile net income to net cash provided by operating activities. So you have to put this wording. Okay, so because this is in the format. And then start to add and deduct the items that are related. Okay, um, that is related to the operating activities. Okay, so you can start first with uh, adding back, okay, the non-cash items, okay, such as depreciation and amortization. Okay, so you have to add back because the net income in the when determining the net income in the income statement, these expenses are actually deducted, okay, but it does not involve any cash movement. Okay, so it is recognized because of the retirement of usage for the assets. Okay, so now because it does not involve any cash movement, so you have to add back, okay, to adjust the net income. Okay. Then the next thing that you have to look is on any gains or loss, okay, on sale or disposal of long-term asset. Okay, so you have to look on any loss or gain on sale of long-term asset. So this is actually coming from the investing activities, but it is recognized as the under operating activities. So if it is a loss, okay, you have to add it back. Okay, and if it is a gain, you have to deduct, okay, from the net income. Okay, because loss and gains usually will involve the movement of cash. Okay, so for loss you have to add back, and for gain you have to deduct from the uh amount, okay, from the net income. Okay, okay, so these are the things, okay, that you can take out from the income statement. Now we are going to look into the items that should be plucked out or should be taken from the comparative balance sheet. Okay, so when I say comparative balance sheet, it is actually uh, the difference, okay, between two periods of balance sheet. Okay, we will use the prior period and the current period, and for each item, for each account under the assets, liabilities, and also equity, you will have to calculate for the differences, whether the current amount of the items, okay, or the accounts increases or decreases when you match it with the prior amount. Okay, so you will have to look on the movement, whether the movement from the prior year to the current year increases or decreases the individual accounts. Okay, so for the operating activities, we will only look into the current assets and the current liabilities. And in determining what to add or what to deduct, you have to memorize. Okay, so for what I can suggest is that maybe you can memorize on the increases. Okay, so if there is an increase in current asset, you should minus the amount. Okay, if there is an increase in current liability, you should add the amount, because the the because the opposite effect, okay, for the current asset and current liability will have, okay, the opposite sign. Okay, so memorize it. So it is better for you when you do the indirect method to memorize, okay, the format. Okay, these are the items, so do not leave out all these items. Okay, so after you add or you deduct, okay, the items from the net income, you will have the amount that you are trying to find, okay, the net cash provided by the operating activities. Okay, so this is the same thing, okay, but it actually categorize, okay, the deduction or the addition by categories, okay. So adjustment for changes in current asset and current liabilities, okay, you can start either whichever categories you can is not wrong. Okay, so you can start, maybe if you want to start with the third categories, also it is not wrong. Okay, so it depends on you, because at the end you will still have the same amount. Okay, you will get the same amount. Okay, so but we do not jumble up, okay, the items. Usually we will when we do the deduction and the addition, we will categorize it according to the groups. Okay. So this is the explanation on why you have to deduct and why you have to add back the amount. Okay, so for depreciation, depletion, and amortization, these are not these are non-cash transaction. Okay, so it does not involve any movement of cash. Okay, so the logic is that you must add it back to the net income, okay, because it does not involve any cash, okay, it's a non-cash transaction, so you have to add back to the net income. Okay, then for the changes to long-term asset, the gain and the loss. Okay, so usually this will occur on the purchase or sale of assets. Okay, so what is the effect in the journal entry? Okay, so usually they will appear in the investing section, but when they are sold, or they are this asset when it is sold or disposed of, it will be reported on the income statement. Okay, so we need to reverse this effect in the cash flow statement. Okay, so we need to reverse it from the cash flow statement. So the what you have to remember is that for loss, you have to add back to the net income. If it's a gain, you have to subtract or deduct it from the net income. So the treatment will be like this. Okay, so if it's a net income, you will net income or net loss. Okay, so you will have to add the loss. Okay, if it's a gain, you will have to deduct it from the net income or net loss. Okay, so for net income, if you add loss, it will actually increase, okay, the net income, and also if it's a net loss, it will also increase the net loss. Okay, the minus amount will decrease. Okay, if it's a gain, okay, when you subtract it, it will actually reduce the net income, and for the net loss, it will actually increase the amount of loss. Okay. This is actually a summary of what you have to do. Okay, apart from loss and gains, there are also some other special items, such as when you receive discounts on bond payable, and also premiums on bond payable. Okay, so where it's a discount, it's actually a loss. Okay, the treatment is actually the same as recognizing the loss, and for the premium, it's actually the same as recognizing the gain. Okay, now we're going to look at the last category. Okay, that is the changes in the current assets and current liabilities. Okay, so you have what I suggest is that you just memorize. Okay, for current asset, if it's an increase, so should you subtract, or should you add back? Okay, so look at the changes in current asset accounts first. So what is under the current asset accounts? You will look at all the other items except for cash. Okay, so you're going to look into accounts receivable, any in for the inventories, okay, for the supplies, And if there are some prepayment or sub accruals, okay, so you will have to look into it whether the accruals or prepayments are categorized as current asset. Okay, so for the increase, you will, for any increase in current asset, you will have to deduct it. Okay, for any decrease, you will have to add it back to the net income. Okay, so this is the explanation in the PowerPoint why you have to deduct or why you have to uh, increase or why you have to deduct, okay, the amount, or why you have to add the amount. So it's already in the PowerPoint that I have given out to you. Okay, now look at the changes in the current liabilities. The treatment is the same, but here for the current liability, it will actually be vice versa. So if, for instance, an increase in current asset will have, you will need to deduct it from the net income. Now the decrease in accounts payable will require you to deduct it from the net income, and for any increase you will have to add, okay, to the net income. Okay. Okay, so you see here, this is decrease, okay, add, and here the increase will have to be added back. Okay, so this is the explanation why you have to add or you have to deduct. Okay, so it's already in the PowerPoint that I have given, so I'm not going to explain it further. Okay. Okay, so what is the non-cash expenses? Okay, why is the non-cash expenses added back? Okay, this is um the explanation why you have to add back the non-cash expenses, because actually when uh, they are deducted actually to measure the net income, but did not require any cash payment in the current period. Okay, because it does not involve any cash payment in the current period. Okay, they have to be added because they were previously deducted. Okay. Okay, so they are not truly sources of cash, okay, even though they are associated with cash inflows, but reversal of an accrued expense. Okay, so this is actually a summary of the changes in the inflows of outflows from the assets and the equity and liabilities perspective. Okay, so for assets, any increases is considered as outflows, and for decreases it is an inflow, and the effect is actually the opposite, okay, for equity and liability. So for equity and liability, the increase will be shown as an inflow and the decrease will be shown as an outflow. Okay. Okay, so these are the positive items. Okay, so these are the positive items: net income, depreciation, loss on sale of long-term assets, decrease in current asset, and increases in current liability. So these are all the items that are positive, okay, the positive sign. And negative items are net loss, the gain on sale of long-term asset, increases in current asset and decreases in current liabilities. So in operating activities, these are the items that needs to be added back to the net income. Okay, and these are the items that needs to be deducted from net income. Okay, so the addition, so this is a summary of addition and also deduction. Okay, so this is how the indirect method is presented. Okay, so the format. So this is only the extraction for the operating activity. So this is how you can prepare for the indirect methods of the operating activities. Okay, start with the net income or net loss, and then write down these wordings, and then you can actually the items here you can actually categorize it according to their categories. Okay, so this is easier because if you do this you can remember that you have already included all the items that is required to be reported, okay, according to the categories. Okay, so the net cash provided by the operating activities will be the net income uh, less, okay, all these items, okay, grouped together, okay, to get the net cash provided. Okay, so this is the indirect methods presented with the indirect methods for operating activities presented with the other activities, the investing and also financing activities. Okay, so in preparing the cash flow statement, what should you do? Okay, so first of all, the information that is required will be from the balance sheet and also the income statement. So usually you will be given a comparative balance sheet and also an income statement to uh, start doing the calculation and preparing the cash flow statement. Okay, so the first step starts with laying out the statement, the balance sheet and the income statements. Okay, then compare the two balance sheets. Okay, the previous year and the current year. So you have to compare for each account of the balance sheets. Okay, from current asset, uh, long-term asset, current liability, long-term liability, and also the equity. So every account will have to be calculated. You will have to be compared and calculated to see, okay, the effect whether from there is an increase or decrease uh, in the activities from the prior year to the current year. Okay, and the increase and decrease must be listed out, okay, in another column uh, at the balance sheet, okay, to look at the movement. Okay. Okay, then compute the changes in cash from the balance sheet. Okay, determine the net change in cash. Compare beginning and also ending balance. Okay, then you will start to explain the net cash change of cash by analyzing all other accounts. Check if the balances have been impacted by accrual-based adjustment or other non-cash activities. Okay, then take the following figures from the income statement. Okay, start with the net income, depreciation, or any gains or loss. Okay, then reconcile the non-cash item as depreciation with the net profit or loss of the business and adjust for the decreases and increases in asset and liabilities for gains and losses on disposal of asset. And lastly, arrange all of the items according to the three major categories. Okay, operating, investing, and financing. And finally, you complete the statement. Okay, so arrange it in the complete cash flow statement. Okay, so this is the steps. Okay, so first you have to calculate the changes, okay, and determine whether it is an increase or decrease to the accounts, okay, from prior year. Uh, okay, so here we start the what this this person do is that he uses or she uses the current year and deduct with the prior year. Okay, so this will actually show the change, okay, and the change is a positive, okay, because there is an increase from the prior year to uh, the current year. Okay, so you can actually change, okay, whether you want to use the prior year here and the current year here, or use this format, okay, because the change will be the same, only that you have to remember, okay, whether this is an increase or this is a decrease. Okay, so increase is from the point of view of the prior year. Okay, okay, decrease is also in the point of view of the prior year, okay, to the current year. Okay, so you can use whatever format, okay, that you deem is comfortable for you to calculate the changes, but you must remember when you say that it is an increase or decrease, it is from the point of the prior year to the current year. Okay. Okay, so this is the same, calculate for all the changes of the individual accounts. Okay, then this is the information from the income statement. So what are the information that you need to look out? Okay, the net income. Okay, and from here you're going to look into the interest. Okay, any interest expense or interest income. Okay, so these are revenues. Okay, then this gain on sale of investment and loss on sale of plan asset. Okay, so this must be included, okay, because this is non-cash item that must be treated separately. Okay, and also another thing that you have to look is the depreciation. Okay, so here it does not list out the depreciation expense individually, but it's stated that depreciation is included in the operating expenses. So you're not going to take this amount, you're going to take only the depreciation expense. Okay. So now this is a preparation of the cash flow from the operating activities. So take the net income. Okay, so the net income is derived from here, from the Laguna Corporation income statement, 16,000, and then look out for the depreciation. Okay, the gains and loss. Okay, so depreciation is 37,000, gain is 12,000, and loss is 3,000. Okay, so what should you do? Okay, so for depreciation, you have to add back, okay, the 37,000. And for the gain, you will have to deduct, okay, and loss, you have to add back. Okay, now, uh, you have already prepared, now you have already taken all the, into consideration, all the non-cash items. Okay, now you're going to look into the changes, okay, in current asset and current liabilities. So where do you get this amount? So this amount is from the comparative balance sheet. Okay, so you're going to take the amount, okay, from the comparative balance sheet here. Okay, but you have to know the effect. Okay, what is the effect? So for instance, here accounts receivable. Okay, so the change is 8,000, and the effect is that it is a decrease from the prior year to the current year. So the change is 8,000, the amount is 8,000, but this is a decrease. Okay, so how will you treat it in the in preparing the cash flow statement? Okay, so because this is a decrease, okay, you have to add back. Okay, so any decrease in current asset will have to add back. Any increase in current asset, you will have to subtract or deduct. Okay, so look out for all the accounts under current asset. Okay, so what is apart from accounts receivable? So what are the other items that you have to report for the current asset? Okay, so there are accounts receivable, inventory, and also prepaid expenses. Okay, so you have to include this in the um, okay, the in the cash flow statement. Okay, so look at what is the amount and then what is the effect. Okay, so you have to record it according to the effect. Okay, so for current asset, okay, any decrease is added back, and any increase is subtracted or deducted. Okay, so all of these three items are under current asset. Okay, now look for the current liabilities, the items under the current liabilities. Okay, so look at what is the changes, okay, the amount of changes and the effect of changes. Okay, so for current liabilities, there will be accounts payable, accrued liabilities, and also income taxes payable. Okay, so this is the amount of changes and this is the effect. So now what you have to do, you have to determine whether if there is an increase, you have to deduct, or if it's if it's a decrease, you will have to subtract or deduct. Okay, so you have to know what should you do. Okay, subtract or add. Okay. So now for any increases in accounts payable, okay, you have to add back, and any decreases will have to be deducted. Okay, so you just have to remember. Okay, so if you want to think on the positive items, okay, so decrease of current asset is positive. Okay, increase of current liability is positive. Okay, so if you want to remember it, vice versa. Okay, so for the negative items, so any increase in inventory in current asset, it is a negative, and any decrease in current liability is a negative. Okay, so total up all these items under the adjustment. Okay, so you will have the net amount. Okay, then from the net income, you will deduct you will have to add or deduct. Okay, so it depends on the amounts that you get here. Okay, from this accumulated amount. Okay, so if it is a positive amount, you have to add back. If it is a negative amount, so you have to deduct from the net income. Okay, to get the net cash flow from operating activities. If you uh, if it confuses you, then you can you can add or deduct um one by one. Okay, so for instance, from 16,000 plus 37,000, then minus 12,000, add 3,000, add 8,000, minus 34,000, add 4,000, add 7,000, add 3,000, and minus 2,000 to get to the amount of 30,000. Okay, so you can do it whichever way that you see it is comfortable or according to your understanding. Okay. Okay, so that's the end of the indirect method, and that is the end for the cash flow statement. Okay, so thank you all. Okay, Assalamualaikum.